depending from fellow investors are joining from. Happy to invite us all to our first inaugural and member education forum. And happy to note with delight the presence of our CEO, Sarah Wahogo. Thanks for joining us in this call. It adds to the fact of your delight in seeing our members forever educated. I request that after Amish is done, we'll invite you to speak to us in a short nugget. Also, we'll be looking through when our board members join. Equally, we shall give them opportunity. So this forum is in keeping with the cooperatives principles, which one speaks about educating our shareholders and members. And so we know that currently we are in the heartfield of electioneering period, and politics, it is at its height. And as investors, we are not kept away from this. It is in tune that we know how to navigate through this in a manner that keeps us going. And to assist us navigate through this is our partner and closer ally, Mr. Amish. Amish is an investment specialist in capital markets by far, and has got his heart and soul deeply rooted on matters investments. And so we are happy once again to have him here to take us through what it is that in the past has attended our electioneering period and the effects thereof that has affected the investors, the lessons learned, and from those lessons, what it is that we can prepare for in this year, so that we don't get into a psyche that messes us all again, but then get into it with the knowledge of how to put our pounds and shillings in a venture that will be worth it. So Amish, we look forward to your presentation. You shall take us through the first round, and then we'll have a commercial break where we'll share with the investors who logged in some of the products that we have, which attend to the presentation that you shall make. So Amish, without further ado, I do welcome you. If you have your team, you can equally introduce them so that we start. I want to thank all who've logged in. Get up your pens and notebooks, sit upright, and let us learn from that which Amish has prepared for us. Over to you, Amish.
Well, thank you very much, the SIC team, for inviting me on behalf of the Kenya Association of Stockbrokers and Investment Banks, where I'm the Vice Chairman. I also have Leah Mina, our Technical Services Associate, on this particular call. Thank you very much, CEO, and thank you very much for more than 80 participants for coming on to this call. We are deeply honored, and hopefully the message that we send you here today was very useful for your wealth creation. Before and after elections, timing is an interesting topic, and I think it's well noted, the topic. So well done on the choice of topic at this point in time. So let me speak about indexes, just to give you an idea of what is an index. Generally, we track the stock market using index, and if it works, the idea is of the index that we are able to ensure that we can track the market. We track an index as a basket of stocks specifically, and that helps us to be able to get away from individual stocks. So we do look at an index in order to establish how the market is performing. An index captures everything that we would like to capture. We would like to capture different aspects of the market, environment, politics, economics, everything that we possibly can. And we feel that the market is very important for us as a result of that. Session 1, therefore, is elections 2017. I'll take you back to what has happened. Let's look at the before and after scenario. Let's dive into what happened. What you're looking at is just a snapshot of the market. Around that time, you'll see quarter 4 2016 on your left-hand corner, and you'll see quarter 4 2017 a little down. Elections were kind of around the October mark of 2017, and if you can see the index, you'll notice that the index on the fourth column was 3729, and therefore it tells you that that's the index that we've been tracking. The Nairobi Securities Exchange 20-share index has been coming for more than 30 years, and therefore that's the key index that we track. There are different other indices that have come up, but this is the key index that we tend to track over this period of time. And just to point out that this is the time that was around the 3,700 mark. You will note that, say, a year before, it was about 3,100. So interestingly enough, as elections was coming, as the election fever was picking up, it actually went up over that time. What's interesting to note is post-October elections, November, December, how it performed, stable, and that's also just something for you to note. So please make a note, everybody, with your pens and papers, as there will be some notes for you to take around the 3700 index around quarter 4 2017. The next slide will now show you what happened from 2017 to 2018. Now you'll see the NSE 20, which is the brown one, and that's quite interesting. The brown one is NSE 20 2018. The gray one is NSE 20 2017 index, and just goes to show how the market was at that time. So on the left-hand side, you can see the graph, and you can see the year 2018 and how it was performing relative, and you can see that 2018 the index dropped significantly. So the index did drop for NSE 2018 post elections. Of course there were issues, and that's why the index is important. It tends to track what's happening in the country, and we believe it is a barometer of
Mr. Amish, sorry,
yes?
Will you put your mouthpiece a bit close?
Is it clearer now?
Yeah, you could possibly just speak up a little bit more.
Okay. Can you hear me now? Is it better now?
Loud and clear.
Okay, thank you. We've always said that the index at an exchange is generally a barometer of the performance of the public sector and the performance of private sector combined. As a result, that's why we track an index. And really, it just goes to show the overall performance of a country combined. As a result, you can see here that taking into account all the factors, how the brown line just dropped, and you can see on the left hand side the 3500 mark around May 2018, And then from till September 2018, the 3,000 mark. And then November 2018, December 2018, below the 3,000 mark, somewhere around the 2,750 mark. That just goes to show you the kind of impact that the 2017 elections had post 6 months, and then post 1 year by the time October 2018 was turning around. Some of you who are fast on calculators would, or without, will be able to calculate the drop in index as a percentage. As a result, you would take, say, 2,750 index around November 2018. You would take that index and then deduct the 3,700 from before, because you're making notes. That's probably 1,000 points reduction. So 1,000 points on the index divided by the 3,700 to begin with, you can see you're down just below 33%. So it's quite a significant drop. So then what happened till 2020? So the NSE 20 share index is the red one at the bottom, and you can see that how it has performed through 2020. So 2650 is where it started. We left 2018, 2019 was probably around the same mark. Then we start 2020 with 2650. We come down all the way down to 31st of December 2020. Unfortunately, we've dropped down to around the 1900 mark, mark. So we are now down, when you look at it, we're down from 3,700 to 1,900. So we're down 1,800 points divided by the 37. So we're down about 50%. And we're down 50% in 3 years, approximately. So a 50% drop in 3 years in the index is on average a drop of 17% per year. So that's just a generalized view of how stocks in the index have performed. And of course, the NSE 20 share index is comprises the bulk of the stocks listed at the offerings of the Nairobi Securities Exchange. Now, when you look at 2021, you'll see on the left-hand side at the bottom, 4th of January 2021, over here, around the below, well, 1875 mark, and how it performed through up to June, kind of up and down a little bit. And then suddenly it shot up around July and August. And then again, it crashed all the way down, December. And subsequently, you can see that it's kind of settling around the 1900 mark. The small gray box in the corner shows you the index as of yesterday, and that is 1700 index currently, which is really sad, really sad. 1700 is actually below the 1800 mark here. And if you go backwards, then that is 2000 points lost since the elections. So 2000 divided by 3700. You can see how major that drop is over this period of time. So who's fast? 2000 divided by 3700. This is how we do these calculations on the index. That's 1700 points lost. You divide that by 3700, and you can see that 1700 divided by 3700 people is about 46%, still 50%. So 50%, 45, 50% drop over an extended period of time. So 2017 to 2021, 4 years, If you take a 50% drop divided by 4 years, then you're about the 13% mark. So 13% annual drop, decline in the index since elections 2017. And that's really a reflective of the performance of everyone combined. And we can see where we are. There is another index, and I think it's just good to note that FTSE of London and NSE have an arrangement, and so there is another index to look at a different viewpoint. This is a 25 share index that the FTSE puts in place. Now, each index has its own methodology. It can be a little bit complicated about how the index is computed on a day-to-day basis. The FTSE one is probably much more well structured for the international market. And as a result, when you look at October 2017, at that time, they were showing an index of 206. And if you look at it now, it's about 182, 190. So not too bad. It just goes to show that an index can be constituted in a different way. It can have a different methodology. It can have different framework around an index, and it goes to show that how even individually one can create an index in order to meet one's expectations. And so this goes to show you that using this index, if somebody invested in the NSE 20 share index in around October 2017, how much their portfolio may have been down. But if you had invested in the FTSE NSE 20 index around, I think they launched about 6-7 years ago, then you would see around not that significant drop. But obviously there's been no growth, so the direction is downwards, obviously. Now, this is not good. We all seek to double our money. We all seek to double our money. And Leah, there's no shortcut. So I can't give you cash as notes, and then you put it in front of a mirror and come and say, Amish, well done, you doubled it. The real way to double your investment is to use the rule of 72. So make a note of the rule of 72, which is a compound annual kind of computation. The rule of 72 says that if you take 72 divided by the number of years, then that will give you the compounded rate of return that you require in order to double your money. On the other hand, if you take 72 in the numerator and divide by a compound annual interest rate, then you'll get the number of years in which your money would double. Now, if we had put money in 2017, that'll be like 2018, 2019, 2020, 21, 2022. So 5 years. If we had taken the 72 divided by the 5 years, 72 divided by 5, we would get 14.4% annualized, compounded annually, positive. And you can see that the index has done that negative. So obviously not good. Obviously not good. When you look at the FTSE index also, if it has dropped around 20 points, which is about 10% drop in that period of time, then again not good. Again, not good at all. However, these don't take into consideration kind of the dividends that might have been earned on a portfolio. It just goes to show that if one had invested in the index, and this is very possible in international markets, there's a lot of investment in indices which track markets, then that would have been the loss. So instead of earning in 5 years, the 14% annualized rate, which roughly works out to 70% plus, you can see with the NSE 20 index, it was down 50%. If you look at somebody seeking a higher return and saying, no, wait a minute, 14 is still low on the low side, I seek 20%, then one would have been looking for 100%. So then 72 divided by 20 would be just 3.5 years. So somebody looking at 20% compounded annually would be looking for a return to double their money in 3.5 years. And so it's 5 years down the road. And of course, there's 50% less as a drop. So it tends to show you how we look at before and after situation on the 2017 elections. Let's go forward. Now let's look at elections 2013. If you're looking at the slides, should be a blue slide, a blue box, and on the top top right hand corner, March 2013, 4861 was the index. So we had an index of 4861 of March 2013. Just goes to show you how high our index has been. So I think what was there important to show you is that if that was 48, it means that between 2013 and 2017, there was a drop again of around 1,100 points as elections 2017 was coming up. So there was a drop of 1,100 points from the previous elections over a period of 4 years, 4.5 years. So it goes to show you how the markets are reacting to the environment, to the environment. Let's look at elections 2007. And you can see that we had an index of 5,646 in 2006, 2007, 5,400, and then 2008, 3,521, 2009, 3,200. So again, what happened between elections 2007 and elections 2013 was a drop, 4,800 points there. And so there was a drop of 600 points around that between the two elections, and goes to show again how the environment was reacting. We can look at elections 2002. You should be looking at a graph, and let's look at how that graph is looking. So 2002 was, the index was around 1,500 area around the elections. So we're looking at around that kind of level. And I hope you all note that actually where we have come 20 years, we've gone 20 years back in terms of our index performance. That's how far back we have gone as far as our environment is concerned. That just goes to show you the kind of the mood out there amongst investors. The mood is obviously not good. It's actually, and we've been saying this, that it's been not good for a long time. And so we've gone back 20 years as far as the mood of our market is concerned. Also, although the market capitalization might be higher, maybe the volumes are higher, but the underlying is the fact that the NSE 20 share index is showing you that we are back 20 years as far as tracking the performance is concerned. However, you can see how beautiful the performance was between 2002 and 2007. So you can see how fast that growth was from, say, 1,500 to almost 6,000. And this was our best time. So 6,000 minus 1,500 is 4,500. So if you take 4,500 divided by 1,500, you get a 300% return in 5 years, which is an annualized return of 60%. 60% per year. And that just goes to show you what a stock market can be. And therefore, it's interesting that you should note this. So let's look at domestic listed shares as you look at this particular market. Why are we looking at shares? Because it's probably one of the dominant asset classes. One of the most important things that you should consider is the dividend yield of companies. And you can invest in a stock and you get dividends from the company. So dividend companies pay out dividends and bonus shares from time to time. And that's why dividends is very important. I'm using this particular site just to track the dividend yields. And if this is correct, then Standard Chartered, BAT, KCB, NCBA, ABSA, Bank of Kigali are giving you 10 plus dividend yield percentages, which is fantastic. So if you can get into the market and you're getting these kind of yields going forward, if they can, and you can project the kind of yields, then it's a huge worthwhile investment to get into the market in order to tag onto these returns. Now, dividend yields is different from capital gain returns. So when the stock price moves back up, then hopefully there will be capital gains as well on top of dividend yield. So here we are with the dividend yield as a very important concept to always be looking for investments. So when you look at the total stock return, you're always looking at you can look at a formula, and that's why dividends is important. We look at total stock return equals the total dividend return plus the capital gain effectively, which is what the formula there is showing, and that's what you should keep in mind. On the right hand side, just for your side, always look at cash, because when you look at cash in terms of companies, how they're growing their companies is always important for you as an individual also to be able to understand how to look at the businesses. Retained earnings is important. Future earnings is important. If you find that these investments going into the future, hopefully that will pay off. So how is our market positioned today? And one of the things just for your is just that you should know that, of course, Safaricom is huge out of the entire exchange. Between Safaricom, Equity, KCB, Breweries, and Co-op, ABSA, these are the biggest companies, and they obviously contribute more than this list is about 90%. Even if you just take the top three, then you will have probably covered the entire market. And therefore, it's not difficult for an individual to pick and choose a stock. So is diversification really necessary? Is complexity really necessary, or is it just put all your eggs in one basket and keep investing, and keep going year on year on year and see how that particular company does? Is also something that is possible, because you know that company has been around for many years, will be around for many years, and you expect that there'll always be some growth, going forward. So 2 tips. One is the price earnings ratio. You've seen the dividend yield. A price earnings ratio of less than 5 is cheap. Less than 5 is cheap. So you take the share price, you divide by the earnings per share, and you get PE ratio. This is very important for you. So you should be able to do this quite quickly. And anything less than 5 is cheap. Less than 10 is attractive. It starts getting expensive. It gets to 15 and 20. And that's what you want to keep an eye on. So the lower the PE ratio, generally, the more attractive a stock is. At the same time, we always look at free cash flow. So try to look at cash flows as well to see whether the company is generating the cash flows. This is very important. When you see companies continuously in negative territory, one tends to be worried. But generally speaking, look for positive cash flows that are being generated by a business. That gives you the strength of that business. So it's not easy to create a portfolio on your own. There are some stocks that will go, obviously, that are investing now. They're going through an investment cycle. So maybe you want to hold back. There are some stocks that have just dropped and are going to grow. So those are the ones, to look out for. So you combine PE ratio. you combine free cash flow analysis, and you combine dividend yield. We need to look at domestic listed bond market. This is 600-700 billion plus. So that's why we need to look at bonds, the fixed income, those that want to diversify or don't want to do the equities market and are looking for a safe investment. Yes, of course. Look, the bond market is not too fidgety around the elections, but what is important is that if one is an active trader, one does have to track, pre-election, post-election. But generally speaking, once you're in a bond, most people tend to hold it till maturity anyway, so they don't really be concerned about the fluctuations. What it just goes to show you is that if somebody takes a 20-year, 25-year view, you can get 14.6, 15% on your money. And so, like we said, if it's 6 years, you're getting around 13%. Nowadays, it might have gone up a little bit. One can also invest in 3-month treasury bills or 6-month treasury bills and get 6 or 7 or 8% anyway. So treasury bonds, very important. Treasury bills, very useful to invest in as well. S&P Kenya, S&P also have a sovereign bond index. It's just good to see that the way they looked at it is somebody invested 10 years ago at just below 200 index points. Then by now it's about 500. So it just goes to show you that there is growth in the bond market. And therefore a 10-year return is showing you 13.44%, which is a good return, for 10-year money. Let me get to session 7, and I hope everyone's making notes. I'm going to be talking through this. The first is the unquoted securities platform, the USP. It's a new product offering by the Nairobi Securities Exchange. Keep an eye on it. So they have different segments. They have different, and then going forward, the new regulatory framework has been announced for 2022. So going forward, there'll be a lot of changes. If that is enacted the way it is, there will be no GEMs anymore. There'll be no AIMS market anymore. There will just be 4 segments: 2 for MIMS, for large corporates, and 2 for SMEs. And so keep an eye on that into the future so that you invest in SMEs. The new framework is beautiful. It's 183 pages, and it's going to be a revolution for our capital markets. We finally have waited 20 years to change the framework, and once enacted, I think there'll be lots more activity that will be happening at stock exchanges. Crowdfunding is coming as well. We're waiting for the gazettement at any time. Be ready to engage with crowdfunding on equities, and this is going to be a whole new area. It's going to be exciting, and there'll be lots of SMEs, we believe, looking at crowdfunding. Online forex trading has been a number of licenses, a lot of success already, a lot of investors forex trading online, and of course, if one wishes to do it, by all means do it. Cautious, be caution. Don't put all your eggs in one basket. That obviously requires diversification, a small proportion of your portfolio. If you are a trader type mentality, then please continue to do so. Investment and trading are different, and so one needs to look at their own personal situation. One of our CASIB members has started artificial intelligence and Robo Advisor. They believe that Robo Advisor is the way to go into the future. The Robo Advisor takes some of your personal requirements, plugs it into the system, and it automatically generates a portfolio for you. And then it goes out into it automatically puts out buy orders into the market, and builds and monitors your portfolio. Real Estate Investment Trust by one of the products has come up with an interesting way for retail market to access, called VUCA. Keep a look into VUCA. It's an interesting place for one to interact with in order to for retail participants to get into the REIT for 2 of the products issued on the USP by Acorn Holdings for accommodation, for student accommodation. Foreign equities, one must invest. If you had invested in Tesla, If you had invested in other companies internationally, you should do so. It's not that difficult to do. There are various platforms available, and one needs to do your own research. We call it the DYOR. So do your own research and do access foreign equities. India is currently with IPOs, very exciting IPOs. They're going through 6-7 IPOs in the same month, and so India's market is quite interesting too. Going forward, the African Exchanges Linkage Program is going to enable investors in these different African markets acquire shares or securities in other markets through their local broker. And so sitting in Nairobi, one will be able to access Dangote in Nigeria, companies in Ghana, companies in Egypt, companies in Morocco, etc., South Africa. And so it's going to be very exciting. The African Exchanges Linkage Project, spearheaded by the African Development Bank, and that's also something new that's coming up. I've tried to summarize, just give you a snapshot. As far as crypto is concerned, definitely, please do look into crypto. We think that crypto is amazing as a product, but again, it's buyer beware. The risk is totally yours, and we think that that's going to be key. You should be involved in crypto. There's nothing. Kenya is quite heavily ranked up there in terms of trading, and I think therefore that that crypto is important. Just don't tell your parents about trading crypto. When I told my mother, she removed my name from her will and transferred all her property under my name to her name because she thought I was crazy. So do be so careful. The next session is investment strategy, and one has to create a balance, and most people get this wrong. Assets versus cash. On the one hand, you could invest make investments that just grow assets, and then they don't bring enough cash, so you're struggling because you can't pay bills, or you can't do certain things that you wished in terms of your bucket list. On the other hand, sometimes you may have excess cash and not enough asset. If that is acceptable, then that's fine, but then you tend to spend too much cash. So how do you get the balance right between assets and cash? And that's your personal investment strategy. So as you develop your strategy, develop the assets on the one hand that are growing, and you're not touching them because you expect them to grow over 3, 5, 10 years. On the other hand, you're expecting cash as well from these investments. And so if you look at the market today, would you invest in shares at 1700 index, hoping that whoever comes into power from August this year will focus on the economy, and therefore the economy will get back? Will the environment be great, and therefore will the index turn around? Will investors become more positive? The economy has a lot to counterbalance going forward, and it depends whether the new administration will be able to do that, because there's a lot of fundamental issues as well that need to be addressed. So, but if you're investing at 1700, do you take the view that 1700 will go down to 1200 or 1000, or do you take the view that 1700 will go to 3000 over a period of time? Yeah. I think that's good for me. Thank you very much.
Thank you very much, Amish. Wow, that was quite a deep end. You've immersed us into NSE indices, and I think one of the questions was there that what is an index? It feels like Greek. So in the question and answer, I welcome you to go to the Q&A platform and prepare to break down the answers as we shall be going on. I think key into what you've mentioned is that we must now settle on the rule of 72, which you've indicated to us, 72 divided by the number of years to us to guide all the investments that we undertake on on a compounded annual rate. You've also noted to us that with the performance at the NSE, we are literally 20 years back, so meaning a lot to catch up to. You've also rightly indicated that it's worth it to diversify because it's risky to have all your eggs in one basket. You've also indicated to us that lots of developments taking place at the NSE, much of it being the unquoted securities platform, which will see a lot of activity from companies that are not yet listed on the NSE. You've also, invited us to have a close look on real estate investment trusts as a new frontier to focus on. Pretty much good to note. And I think one thing that was coming in your presentation was balancing assets versus cash. And we all know that with the behavior of inflation, it's good to be cash wise in manner of how we handle that. And that is one thing, if anyone misses whatever's been discussed in this session, we would want it to be keen. As you prepare to answer those questions, I wanted to invite our shareholders and investors into some of the insights that speaks to what we intended for this call, and this is to make us wise to the fact that it is in order for us to not have our monies resting on banks. And so as Safaricom Investment, we are promising our visitors who've logged in here that we've got plenty of products worth of interest to us to unlock your potential. And one of them is PEPEA Fixed Deposit Interest. This is a product that assures you of an interest rate to the extent of 12% per annum. This is money that you should be wise enough not to have it in your banks lying idle, but then have it in a venture that makes it grow. You all will agree with me that the 100 shilling, or rather the 1,000 shilling you owned 2 weeks ago, is not the same value after, for example, the change of fuel price. And so you need to have your money in a venture that makes it grow each and every time. And so what stands between you and onboarding the PEPEA deposit plan is just being a member with Safaricom Investment Co-operative. And this one will only earn you 10,000 shillings and a minimum 500 shares at 52.5. That totals to 36,250. And thereafter a monthly contribution of 3,000. Once you are a member, you are fresh and ready to onboard some of these products that we were putting forth. And in that tune, also allow me to invite my colleague, Kennedy, also to take us through one of another investment plan, which speaks to the asset strategy that Amish did speak up earlier, that is of keen interest. And so, Kennedy, just indicate if you are able to unmute and speak.
Hello, can you hear me?
Yes, loud and clear.
Okay, good. Thank you, Felix. And I'm also grateful for the great presentation we have received. This has taken us back to investment 101. Okay, so as it has been presented, there are various ways within which we can invest. We can have money in money markets. We can have money in assets that will appreciate. We can invest in stocks. There are multiple ways we could invest. So at Safaricom Investment Cooperative, we are having a divergent approach to investment. Other than the PEPEA that my colleague Felix has shown you, where you can put in money, and after a year you have a 12% interest rate on the capital invested. We have land and we have housing. Now, under the housing portfolio, Safaricom Investment Cooperative now has a key focus on affordable housing, and as such, we now have launched a product called Miranda Residence. So Miranda Residence is a low-cost housing, and low cost maybe from the price point, but it also offers some extent of luxury. And it's a product that I really want to be taken up by most of our buyers, or rather most of our members, even before it goes out to the public, because the deal is too good. So the project is in Ruaka. We have a parcel of 3.5 acres for which the title deed is under Safaricom Investment Cooperative's name. We have since completed the architectural, structural designs and all requisite information that requires for us to go to site. And the product is now live out in the market for selling. So we have in phase 1 4 different types of unit typologies. This is a studio loft, a 1-bedroom and a 2-bedroom. So the studio is 24 square meters, goes for 2.75 million. Now, this is the money that you're going to expend on a studio when you're buying it off plan. When the unit is completed, we expect a minimum rent of 18,000 on that particular unit, and you can get a rental yield of 8% of the capital invested. So what the market offers in real estate at the moment is around 6%. So you can see the product that we're offering is north of what the market is offering. Now, we also have the capital appreciation on the unit. You buy it now, it's on off plan. 18 months later, after it has been built, if you buy the studio now at 2.75 million, upon completion of that particular unit, the unit won't be 2.75 million in. The projected cost will be around 3.5 million, and therefore we'll have a capital gains of up to 27%. I don't think in the market there's many options that will give you up to such kind of capital gains. So that is for the studio. We have the studio loft giving us up to 18%, 1-bedroom up 19%, and a 2-bedroom up 22%. So the few images that you're seeing are not pictures. These are actual renders of the design that has been done for Miran and have since been submitted to council for approval. So this is exactly what you're going to build, and it's going to look this way, if not better. So the image on your far left is the grand entrance. And I'd like to tell our members that we blasted this to the members last week on Thursday. Today, a week later, out of the 210 and 14 units, we already have bookings of up to 40 units. So, and this means that we've got already a good reception to market. And I'd like you to reach out to us and have your units booked even as we prepare for the main launch next week on Friday at Movenpick. So if you look at the price points, if you look at the location, if you look at the unit typologies, these are units that you could take for 2 different reasons. One, it could be a place for you to live in. These are decent houses, or you can take it up as an investment product. So as an investment product, we'll give you the rental yield, or if you want to exit upon completion of the units, it will give you up to 27% on capital gains. Now, maybe the next slide, Felix. So when people, as Safaricom Investment Cooperative, we are so much inclined towards our members and our buyers, such that we go above and beyond in getting to strategic partnerships, to some of the financiers that would help our buyers to realize their dreams of owning a home. So once we have developed the units for you, we have currently at the tail end of partnering with the Solution Circle, Safaricom Circle, and we also in discussion with Harambee Circle. So what these circles will do is that once you have expressed your interest on a particular unit, based on our MOU with them, you can actually just pay up to 20% of the unit price. Then the entire amount will be advanced to the developer for your unit, and you can be given a longer tenure to make your payments of up more than 10 years. So what that means is that after 18 months, we'll finish your unit. You can occupy the unit while still servicing your payment for the unit with either a SACCO, a bank, or a microfinance. So our team, led by our CEO, has actually visited at the moment 4 circles. We're talking about Safaricom Circle, Solution Circle, Tower Circle, and Harambee Circle, and we are actually closing those MOUs. So I'd like to urge our members to take up this opportunity quick and fast, even before the general public, and benefit from this particular platform. So we have already secured funding. The project is fully funded. We're not depending on customer deposits to build. We have already closed in the contract with the main contractor, and we have market-proven consultants who have designed and will be helping us in executing this particular project. So maybe Felix, just go to back to the previous slide. The previous slide. So just as a matter of emphasis is that these are the unit prices. These are the sizes of the units. And I'd like to note that the way our business case is structured is such that the moment you get to a certain threshold of units, the prices are going to be escalated. So having gotten expressions of interest and bookings of up to 40 units in less than 1 week, we are looking at maybe the moment we get to 80 bookings, we could escalate the prices by almost 6%. So I'd like to give our members priority between today and say next week on Friday, as we go for the main launch where the project will be so much out in the public. I'd like you to take advantage of this period and reach out to our sales executives and book your units. So once you reach out to any of our members, we will guide you on all the steps regarding taking up the product. That's all from me, and back to you, Felix.
Thanks, Ken, for that insights given to us on Miran. Happy to note the kind of yields this project is promising, and worthy that this would excite the market, considering that in just less than 1 week, 40 units have already been picked. Back to Amish. In answering the questions, possibly as I'll welcome 2 or 3 would intend to ask the question. If you have a question you want to raise, you can raise your hand and we'll allow you to ask. So Amish, one person did ask, with the shares going low, is it the right time to buy or sell? You know, try to assist answer that in no technical terms, in a manner that one would really appreciate. And also, I've also seen a question advanced whether Safaricom investment has gotten into cryptocurrency. You realize Amish lost his will to her mother after she mentioned crypto. So we too as SIC haven't gotten yet there too, but then monitoring the developments thereof. So Amish, in a quick round for the questions that have been posed, if you want to attend to them orderly, kindly.
Yes, thank you. I've answered them in the chat, but our index at one point was 5,800. The index is now 1,700. What is the view going forward post elections? And I think that's why there's one group that's focusing on the economy. And if they are able to bring up their policies in a certain way and implement them, will those policies make that difference? Will their overall leadership and teamwork approach deliver results? So what is interesting is that we have GDP growth, but still the index is dropping because the mood is not there. Or is it the lack of savings? It's not the lack of savings, because Kenya Deposit Investment Corporation has 150 billion shillings in millions of bank accounts to pay out. That comprises 99% of everybody's savings account or bank account less than 500,000 shillings. But there's 4.5 trillion shillings in deposits in the commercial banks. So it's not because of savings. And it's not because of lack of GDP growth. So what has come about, it's somehow, it's not around the environment. It doesn't appear to be the environment as far as macroeconomics is concerned. It could be politics, but it is also some microeconomics. But it is also a factor of perhaps what we are discussing today is around how our capital markets isn't electronic enough. Is it accessible enough by using the mobile phone? And it is. And a number of our members and the stock exchange have worked hard to bring out the various access platforms to the market. And so there is a debate as to what is going to drive share prices, and therefore what is going to drive index. Corporate profits are up 2021 from 2020. They're much higher than 2021. So the price earnings ratios are so low, the dividend yields are so high, that one can only take a view that this is a good time to come into the market. It is a time to enter, at least, and take a medium and a long-term view. So yes, I think the timing is great for somebody who can sit in the market for a while and pick the best dividend yield stocks as well. And I think one should seriously look at this as an opportunity. Thank you.
Thanks, Amish. You've clearly spelled it that it's time to enter via a medium and long term. Mr. Devin Juguna, you had a question. Kindly proceed to unmute and shoot it out.
Oh yes, my question is what deposit do you have to place when you are investing on the marina housing development?
All right. Thank you, Kennedy. You can take up that.
Yes, David. With that, like up to 10% of the unit price can be deposited upfront. Then the remaining 90% can be spread across the construction period of 18 months. So we only need 10%. So for a unit that goes for 2.7, you only get 275,000, and there you have your booking, and we process your offer letter, and we can always talk on how to spread the balance to what you're comfortable with.
Thank you very much.
Okay.
Thanks, David.
And there's a question that maybe Felix allow me on the chart that asks, can I see the layout of the individual units? Yes, the units are available. The layouts are available. You could just share your email address, and I'll ask a team member to send them to you.
Thanks, Ken. And David, equally, thanks for that question. I see we are at 8 minutes past. Let me know if there is any other unattended question. If you had planned to ask via chat and didn't manage, we're at the last hour to just have that attended to before we close. All right. So, Amish, in your wrap up, if I'm to, put some layman's question for your final wrap up, do we hold our cash in the banks as we watch the inflation, or consider to have them wisely invested? Number two, what is the lookout post-electioneering period? What should we look out to in the event, hoping for a peaceful one, in terms of the yields that should excite us as investors?
It's very important to always look at return net of inflation. Whatever investments you make, you want to beat inflation, and therefore that is an important consideration. So if you estimate inflation to be 7 or 8%, then you want to beat inflation. Leaving money in the bank account, savings accounts, short-term treasury bills will be less than inflation. So you're negative. Your returns are negative. As a result, you're not growing. You're not really growing that saving base. As a result, you want to bypass inflation by a good margin, and as a result, you do have to think outside of savings accounts, current accounts, the deposit accounts. One has to think outside, and therefore one does want to make a bit of a mix in terms of access to cash, liquidity, etc. Of course, in terms of your financial planning. And therefore, it is important to take some additional element of risk, but at the same time, thinking of bills, thinking of long-term bonds, which have a very low threshold at the moment, is something that one should look at. If you are getting 13-14% on 10-12-year bonds, is there a problem going that long with also part of the portfolio? So that's my overall view, is that one wants to look at the rule of 72. You want to look at inflation, and therefore then you create your own basket of investments.
Thank you. Thank you so much, Amish, and I really appreciate the insights. I see Stephen Muni asking, is PEPEA guaranteed or say ensure that one cannot lose investment? Yes, this being a fixed deposit plan, it is an assured interest gain upon maturity. Patricia, please share the login. Indeed, we shall share this login. If you need the recordings and you're not yet a member with SIC, can you just put your email address on the chat box so that we get a moment to share the recordings. I also did note one of us indicate that back in the years, there was a delay in disbursements of PEPEA. That has since changed. Indeed, we have a team that ensures within the 7 days of maturity, you have your money. At this moment, I want to welcome our CEO, Sarah Wahogo, to give us some of his thoughts and feel of the session and his nuggets too. As she gives that also, I would want to know from us what other topics would you want us to cover in the next session, even as we continue with this, because this will be coming to us each and every month of the remaining portions. And so look forward to more mind-boggling and thought-provoking discussions that not only sets you right as an investor, but also, you know, informs you more on where to put your money. And so, Sarah, I invite you to speak to us. Welcome.
Okay, thanks, Felix. I see that I cannot use my video because it's disabled.
Sorry for that. You can just proceed.
Okay. Maybe before I say anything, I think I had seen Beth, our board member. I don't know whether, Beth, you are in a position to say hi to our investors.
Let me, Beth. I think she's dropped off. She was logged in at the earlier moments.
Okay.
Yeah.
Mine is to sincerely thank Amish and Leah for coming to take our investors through this session. I think it was quite informative and talking of the index, how you know whether the market is performing or not. But mine would be a bit straightforward. And what I would want to tell our investors is that I think it's important when you're investing, you work with an institution, and that would mean that the institution covers you, rather cushions you against the macro and micro environmental risks, macro and microeconomic risks, that is. So you don't have to really worry so much about your investment as long as you can partner and work with reputable institutions. As we all know, everyone right now is talking about inflation effects, and the level of inflation is really growing at a significantly high rate. That would mean that if, for example, you say that you do not want to invest, it would mean that your ability, your buying power is significantly reduced. So it's important that you have an investment where the returns covers and cushions against the inflation. Coming to the electioneering period, I think sometimes I find like elections in Kenya are overrated. Of course, we know what has happened before, and people worry a lot, and some decide that actually I don't want to do anything right now until after elections. However, I think if you ask me, it's not the right thing to do, because at the end of the year, time will have passed. And, time is the most expensive resource that we have, because you cannot buy time and you cannot turn back the wheel of time. So we have to make prudent decisions and well-advised decisions. And one of the things that can give an investor comfort is working with an institution where you are sure that even if elections were to go south in Kenya, at the end of the day, the institution is accountable and liable. So I think from me, Felix, that is it. Back to you.
Thank you so much, Sarah. Very noteworthy points put in there that let us not greet our elections with overreaction, but then take note of the aspect of time. Time being a value of money, and so the decisions have got to be prudent and well advised. And also the guide that we invest in institutions that have got very well structured governance portfolio, and a name to behold. And so thank you, really. That's quite a load of information for our investors to take note to. I've seen quite a number of emails of those of us who want the recordings. We will share this, and even later we'll upload this in our YouTube channel, Safaricom Investment Co-operative. So watch out to our channel. You'll see these are link loaded in some few hours over the weekend. Some question from Sospita, just as a final round for PEPEA. What are the charges if you leave before it matures? Are there any charges apart from the tax from PEPEA? Absolutely no charges. But then if you leave before maturity, you just lose on the interest, but your principal remains intact. Your principal remains intact. So I hope Sospita, that one, and rightly as you've put also, there are no other hidden save for the 15% withholding tax that goes to Mr. Caesar. Joyce Munywa did indicate floated shares in 2018. If you see the portal currently, you'll see a lot of activity of shares that have begun thanks to allocations and the recapitalizations that were done early in the year. So a bit of traction going on. We are just about to finish. We've overrun our meeting, but by about 11 minutes. David Njuguna, I see your hand raised up. You have a question?
Yes, I have a question.
Okay, proceed.
Yes, I'm wondering about the portal. How could I be able to access my portal so that I can see the land rate, the amount I'm supposed to pay back for the land I've invested in? That is
okay.
Yes.
Oh, okay, David. I'll assist you on that offline, just for the safety of your details, because this is a virtual one. I'm ready to assist you. Just indicate to me what's your member number. Just the number.
MMBR 05418. 05418.
5418. I'll get in touch with you right after this. Permit me, ladies and gentlemen, to thank us all for logging in for this call. We shall have many of such sessions in the coming days, and it shall forever be an engaging conversation. So Thank you so much for all who've logged in. We've seen the emails that have come in from all who want to receive this recording. We shall have that one shared. And so mine is to appreciate all of you took time to log into this session. It is forever appreciated. And we shall share communications for the next call session that will be coming next month. And so have yourself a great weekend and a productive week ahead and a peaceful coexistence. Make sure you are a source of peace, because investors can only operate in an environment of peace. So thank you so much, and I wish you a blessed weekend. Bye for now.